In this unit, we finally address one of the core issues faced by all tax-exempt organizations. How do they raise money, and how do they spend it once they've received it? By its very nature, most charitable activity does not generate revenue by itself. When a charity invests money seeking the cure to a disease or provides food for the hungry, those are activities that don't generate money themselves. The charity needs to go out into the public world and seek donations in order to carry this out. The fact that the donor gets a tax deduction for making the donation is a tremendous incentive for raising money, and charities devote a lot of their resources to trying to raise money. Regulation of fundraising is highly complex. For that important issue to the donor, getting an acknowledgement of receipt of a charitable gift, the regulation is rather complex. A written acknowledgement with very detailed, specific information needs to be provided contemporaneously with the gift. All of these details are set forth in a unique IRS publication numbered 1771. You will know by now that most IRS publications are full of fine print, are difficult to read, double columns on newsprint. Publication 1771 is designed for the general reader. It's got large margins, a single column, big print, and the language is a little more easy to follow. It's a brief publication, but its content should be known by every charity. Somebody in every charity should be intimately familiar with all the details of this. This should not be left just up to advice of counsel. It should be embedded in the very culture of the organization. When you as a practicing attorney advise nonprofit organizations, one of the primary responsibilities that you will have is to make sure that the donor process is handled correctly. One step in this is making sure that the organization is committed to applying the principles set forth in publication 1771. For that reason, in this class, you should have great familiarity with that publication as well. Can a nonprofit organization charge money for the services it provides? Yes, it can. Many do. There's one charity that you are very familiar with, and that's Trinity International University, the parent of Trinity Law School. You give a lot of money to Trinity, and that's not considered a donation because you are receiving services in kind for what you give. But as an institution, Trinity International University generates most of its revenue from charging tuition. It does have a fundraising department, and you will be hearing from that department throughout the rest of your career. But your primary relationship with Trinity at this point in your career is that of providing money to Trinity in exchange for services. You don't get a tax deduction for treating that as a donation because it is not one. It is a purchase of services. One thing that's very complicated, particularly in the art world, is the suggested voluntary donation. This is a terribly confusing thing that some charities engage in more out of custom than need. There's an art museum in California that for a very long time has had outside the parking lot a sign saying suggested donation for parking, $25. When you pull up to the gate, an individual holds out a hand, and there's a clear implication that you must give the money in order to park. I've never challenged them and insisted on parking for free, but this clearly is a service, parking, that's provided in exchange for money that is given. If in fact it is well known and widely practiced that people tend to park for free, then potentially you could claim a tax deduction for being one of the rare people that gives a suggested donation when everybody else around you is parking for free. However, nonprofit organizations do a tremendous disservice to the public by making this ambiguous. You can make the life of donors a whole lot easier as a charity if you just make it very clear what activities are you engaging in for which you expect no compensation, that is, those which are truly free, and which of those are services for which payment of a fee or a purchase price is an essential part of what's being received. In the realm of religious organizations, particularly foreign mission agencies, one of the most common activities is for the individual missionaries or providers of services for the organization to raise personal support. You've encountered this if you or friends have been involved in InterVarsity Christian Fellowship or Cru, where individual employees go out and raise money that is intended to support the work that they do for the charitable organization that is the mission agency. This is referred to as deputized giving, and it's very, very complicated. You know from what we've discussed already in this class that you cannot give money expressly for specific individuals and claim a tax deduction for that. However, you can give money to an organization that is under the control of the organization that they can spend on carrying out their purpose, which may involve activities that involve the individuals who tried to solicit money from you. Perhaps the part of the charitable world that has challenged this area the most has been that of Mormon missionaries who, as young individuals, go out for a 2-year mission trip and are often heavily supported by their parents. This raises the question of whether a parent who has spent money without getting a tax deduction to raise a child up to the age of 18 can get a tax deduction for providing similar type of support during the 2 years that they're a missionary. The courts have been divided on this, but in 2000, the IRS gave a very detailed discussion of this in materials that are set forth in your book, Guide to Representing Religious Organizations, at pages 99 to 100. I recommend that you look at that very carefully. Charities can make the world of donors a whole lot easier by setting forth a giving and receipting regime that follows the steps set forward on these 2 pages and makes it very, very clear how the money is being spent and where it is going to be used. Restrictions on gifts are also a very complicated issue. Many donors will attach limitations on how money can be spent, and the organization must honor those requests or be at risk of fraudulently misrepresenting the use of its funds. This is terribly complicated for organizations that often unwittingly back into problems. To give an example, consider a poverty relief organization that is very financially stressed. It has not paid its employees for a long period of time, and it has a great deal of debt that is threatening to make the organization go under. During this time, it decides that it will hold a fundraiser to purchase a $10,000 refrigeration unit for its warehouse. That can be helpful in carrying out food distribution. To its surprise, it is unusually successful, and in making a request for funds expressly for a $10,000 refrigeration unit, it actually earns $50,000. What does it do with the $40,000 that it raised above what its needs are? The organization has too much money to buy the refrigerator, not enough money to stay in business in its other activities. The temptation to spend that money on other activities is very, very strong. At the same time, it is probably likely that the donors wouldn't mind if the money was spent on other activities that would keep the doors of the charity open. However, the charity may not do so without seeking the authorization and approval of those donors who gave them money expressly restricted to use of the refrigeration unit. A charity can prevent this problem by the way that it words its solicitation materials. It can make clear that its intent is to raise money for a refrigeration unit, but to the extent that there are other needs that are great in advancing the charitable purpose, it will use the money for those specific purposes. The regulation of how funds are spent is tremendously complex, and it gets even more complex when you enter into the realm of endowment funds, which are a significant part of many charities, particularly established and prosperous charities, in carrying out their spending of money on their charitable purpose. The regulation of endowment funds is set forth in a uniform act that is called the Uniform Prudent Management of Institutional Funds Act, best known by its abbreviation UPMIFA. This is incorporated in California in the Probate Code at sections 18501 to 510. There is a trap for the unwary practitioner in nonprofit law in applying UPMIFA to its clients' needs. For one thing, it's located in the Probate Code, which is not a part of California law that nonprofit organizations or their attorneys necessarily want to turn to very often. Also, the primary purpose of UPMIFA is to address how endowment funds are spent. But that's not exclusively what it addresses. It also addresses institutional funds, which tend to be all funds that a charity engages in, not just those that are restricted. So in determining how to spend money once it has been received by the corporation, the practitioner and the charity need to look very closely at UPMIFA and also other parts of the corporation's code that are not expressly addressed in UPMIFA. The materials that you have for reading this week go into detail about what the requirements of these sections of the California Code are, and reading those code sections is also part of the reading. As you go through these materials, consider what the role of the charity and its board are in carrying out the fiduciary responsibilities that the board has in determining that funds are raised and spent in a way that conforms with the law.